Did you know that the Your Way HRA powered by OneBridge can offer a better funding alternative for special payment plans? What do we mean by special payment plans? Well, it starts with the tax problem that results when public sector retirees are paid large lump sum separation cash outs of unused sick leave, vacation, PTO, or severance pay. To avoid this tax problem, these separation payments are often contributed into tax-deferred retirement programs such as a 401A, a 403B, or 457 plan through what is referred to as a special pay plan. This defers income taxes on the separation pay. Retirees only pay taxes when they later withdraw funds from these deferred retirement accounts. That sounds like a great way to defer a tax bill on funds that you don't intend to use immediately, right? So what's the problem? The problem is that retirees who will inevitably incur medical expenses in retirement will be using after-tax income for an expense that could instead be paid on a tax-free basis if structured properly. This is because withdrawals from qualified 401A, 403B, or 457 plans, even for medical expenses, are subject to federal income tax and applicable state and local income taxes at the retiree's ordinary income rate. This is where the Your Way HRA comes in. The Your Way HRA is a tax-beneficial alternative for public sector retirees who will inevitably spend some of their retirement income on medical care expenses. By contributing some or all of these separation payments into a funded Your Way HRA plan, the employer and the employees benefit. First, non-elective or mandatory employer contributions of leave cash outs made to the Your Way HRA are exempt from federal income tax and FICA. Second, funds contributed to the Your Way HRA can be invested and grow on a tax-exempt basis. But most importantly, withdrawals from the funded HRA to reimburse qualified medical expenses for the retiree, their spouse, or their dependents are exempt from federal income taxes. Retirees have a tax-free investment account they can use to cover the costly medical care expenses they'll inevitably experience during retirement. Let's see how much money a retiree could actually save if some or all of a leave cash out is funded into a Your Way HRA instead of a 403B retirement account. We'll look at two retired teachers, Evelyn and John. John directed his separation pay into his 403B. Evelyn directed her separation pay into the Your Way HRA. Both John and Evelyn spend $450 a month on Medicare and other out-of-pocket expenses, equaling $27,000 over 5 years. Assuming an average tax bracket of 25% for both John and Evelyn, John would need to withdraw almost $36,000 of taxable income from his 403B to cover the $27,000 in medical expenses. But not Evelyn. Since her cash out was contributed into a funded Your Way HRA account, she withdraws only the amount she needs to pay her medical expenses on a tax-exempt basis. Evelyn doesn't lose any of her retirement savings paying taxes on those amounts. Evelyn's funded Your Way HRA saved her almost $9,000 in taxes over 5 years. Why should retirees have to exhaust their retirement fund down the road to pay taxes on medical expenses they can pay tax-free? Well, with a Your Way HRA powered by OneBridge benefits, they don't have to. If the tax savings isn't reason enough to choose Your Way HRA, how about the added comfort of knowing that you're choosing the largest funded HRA administrator in the country with industry-leading technology, including a single sign-on portal and mobile app, plus white glove account management, friendly personalized customer care, full service compliance, and more. Start saving more for your retirement future with the modern, seamless, and triple tax advantaged special pay plan alternative, Your Way HRA.